Hi and welcome to Yahoo Personal Finance. I'm Alex Brophy, and joining me to talk about yield investments is Financial Spectrum's Brenton Tong. Brenton, thanks for joining us.
Thanks for having me, Alex.
We've recently had a huge run-up in yield stocks, but still the likes of CSL, Coke, Commonwealth Bank are offering 5-6% yields. Where do you see the best place to earn income on your money at the moment?
With regards to earning income, it's a vital component of your investment portfolio to ensure that you're getting some sort of income. If you're gearing, it's even more important because you want to have that stability of a little bit more money coming through. Yield has certainly been one of the big stories over the past 12 months. A lot of people have been chasing it, and the yields on offer on the ASX have been just nothing short of exceptional. With the run-up in yield stocks that we've seen over the past 6 months, those yields have come back a fair bit. However, you really have to take things into context. You can get maybe 4.5% on a term deposit at the moment. The cash rates are somewhere in the 3s, depending on which bank you go to, and a lot of the banks are doing specials in the low 4s. So the money on offer from cash at the moment is relatively low in historical terms. So finding a dividend yield of anything higher than 4%, especially if there's franking involved, is actually giving you a better return than cash, with the potential for capital upside if the market should continue to climb. If you're looking at a long-term investment, then obviously you're getting rid of some of that short-term volatility as well. So the yields which you're finding on the ASX at the moment are still really, really good. Throw in the franking, and they're still an excellent story.
Sure. And for people with an aversion to shares, and not wanting to keep it in cash, what other yielding investments are available out there?
Not wanting to keep the money in cash, because that's obviously the next obvious option when it comes to chasing yield. What we're finding is that some properties, especially close to the city, small studios, 1-bedrooms, while they may be a little bit pokey, they are returning quite good rents, which are still in excess of the cash yield.
Okay.
Obviously, the downside of a property, it's illiquid. It is not a small asset, so if you've only got $10,000 or $20,000 to invest, then that's obviously not going to work for you. Even if you had $500,000 to invest, then you're going to be significantly overweight into real estate. But we are finding some of our investors are finding a fair degree of comfort with some of the yields which they're getting on some of their real estate portfolio.
And taking tax into consideration, how does that change your view there?
The tax really comes down to the specific property when you're looking at what you're getting into. Older properties do yield a little bit better, but newer properties are going to give you some depreciation benefits. The depreciation benefits on a newer property are not too dissimilar to the level of franking you'd actually be getting on a stock portfolio. If you are chasing yield at the moment, generally, if you don't have enough money to buy a good yielding property, or if you've got enough but it's going to leave you significantly overweight, we'd still encourage people to look at the stock market. The volatility on shares really is only an issue for when you sell, and if you have a long time frame that you're looking for example, in retirement, providing you set your expectations of what you're trying to achieve, balance your portfolio appropriately so you've got enough cash sitting there to take care of your short-term cash needs, you might find yourself not having to sell your stocks for 5, 10, 15 years. If that's the case, then the yield is almost the only story that you really need to consider from that perspective there. So I probably do encourage people to diversify their portfolios and I guess diversify their mind and their expectations across some of the asset classes.
Right. And in terms of balancing your portfolio that you touched on, how important is it to consider the investments that your super is in when looking across the board?
It's vital, and I meet a lot of people. I talk to a lot of mums and dads, a lot of professionals, just a lot of investors generally. And what I do find is that the vast majority of people don't truly have a proper comprehension of where their superannuation is at any point in time. Australia has one of the best superannuation systems in the world, arguably. It's complex, they change the rules all the time, generally people don't like it, but when you do look at it on a global scale, it is actually quite good. We have more savings per capita than most other countries as well. What we do have, however, which is a bit of an anomaly considering that Australia is, I guess, what you'd call a more property-oriented country from an emotional point of view, is the allocation of pension and superannuation money towards the stock market is actually significantly higher than most other countries.
Right.
Which is a little bit of a conundrum because when I speak to most people, a lot of people are a little bit more anti-stock market, especially through the GFC. Because superannuation is very complex for a lot of people and a lot of people don't understand it, most people don't really take the time to significantly look at it. Some people will know they're in a balanced fund. And that might feel good, that might sound good, but a balanced fund still may have 60% of their asset allocation towards the stock market. So if someone has 100,000 in super in the balanced fund, they might have 50 or 60 grand. So if I was to suggest to them that they take 50 or 60 grand of their superannuation money and invest that in the stock market, quite often they'll say, I'm not really that comfortable with that, even though that's actually where they are at the moment. So I do try to go to great lengths to make sure people take the effort to see where their money actually is, because at the end of the day, it's your money. It's up to you what you do with it.
Right, some really interesting insights there, Brendan. Thanks for your time.
Thank you.
See you next time with Yahoo Personal Finance.